Welcome to the daily update, where I'll go over the action in the market for Monday, October 21st, and then we'll see how things look for Tuesday, October 22nd. On one hand, you could say, okay, we had a pullback. Maybe things are looking a little more negative. And that's true. We've worked off a lot of the extreme positive conditions in the short and intermediate term, but we hit a bottom during the day and then saw a really nice bounce up and didn't really close all that much different. We weren't down all that much. So there's this buy the dip mentality that's going. So as of right now, the decline that we saw in Monday's session just looks like a pullback, some profit taking. It doesn't really look like the climate has switched over to negative, but that can always change. Now, we're dealing with the week after options expiration, which is more negative than positive. We're also dealing with some weak seasonality after we had been dealing with some positive seasonality, at least last week. Maybe those together, we have interest rates really going up. You combine that into the whole equation, and maybe stocks are going to be under pressure a bit. We'll be watching this to see, are we still looking positive but pulling back? Is this going to turn into an actual decline? Are we going to actually shift over and turn more negative? Those are the things that we'll be watching for going forward. There's a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. If you want a link to get to the website, it's below this video. There's also a video that will tell you more about the program. If you have any questions, here's an email address. One of the benefits is that you have access to the videos as soon as they are prepared. Also, the daily video is the real foundation of the analysis that I do. We just finished going through the weekend and I did all the weekly videos, and those are great to get a little bit of a different perspective, a bigger picture look at different things. But if you want to see the incremental changes from day to day, and that's really what technical analysis is, you're looking for these subtle shifts from positive to negative, negative to positive. And yeah, there are a lot of things to look at. There are a lot of charts that I go through. That's how we detect the overall climate that we're in right now. And through that, that's where I ultimately come up with the analysis in the daily video. Okay, let's go back and talk about what happened. We did have a lower open with prices rising above the daily pivot. So lower open, but we immediately went up. We got above the daily pivot at 58.61. We hit resistance at the unchanged level. Now we have this thing called R levels, resistance levels, and support levels, and they're different on the intraday chart every day. Well, a built-in either support or resistance level is the unchanged level. And that's what happened in Monday's session. So we hit that unchanged level, and then we started to decline. We got back below the daily pivot. We went down below S1 at 58.50. We fell below S2 at 58.35, and it was pretty quick. And once it kind of subsided and a little bit of a foundation had been built, we ended up finding support at around the 58.25 level. And then we rebounded. We got back above S2, we got back above S1, and we closed slightly above S1. So by the time we were done, it wasn't that big of a percentage change. We were down 0.18%. We're still below average with volume, which in this context you might see is a little more positive. We pulled back and volume was below average. Now, it was a week ago on Tuesday. That was the high volume day that we saw last week. All the other days were below average with volume. But when we saw the above average volume day, that was the down day. The up days are still on below average volume. So this is kind of encouraging that we had a down day that was also below average with volume. We are still positive in the short, intermediate, and long term as measured by the moving averages. We're a little bit concerned right now about interest rates. The 10-year yield's really going up, and I'll talk about that here in just a moment. And that is putting some pressure on stocks. We have the dollar also rebounding, which can put pressure on stocks. The stock market likes a weaker dollar. And I'll show the chart later on, but the dollar was able to get back above its 200-day moving average, which over the weekend I was pointing out, maybe that will provide resistance. It did there for at least for Friday's session. Well, now it's actually going above that 200-day moving average. We want to keep an eye on all the geopolitical things going on that the market just has really not been paying attention to. And then the domestic issues. We've got the presidential election coming up. Is something strange going to happen there that's the market is actually going to react to? So far, it hasn't really been much of a reaction in that way. Some comments, even though we were down with the S&P and we were kind of more negative than positive when you look at everything together, the NASDAQ and NASDAQ 100 were up. We're still under 19 with the VIX. So even though we had a down day, it didn't really spike up as well. It went back up, but not over 19. We're keeping an eye on things going on in the Middle East, where we had dropped below $70 with oil. Now we're back above $70. And our short-term list is really kind of short right now. We just have the Williams percent or the CCI 20, where the CCI 14 fell off, and the stochastics. Intermediate term, the PMO studies, the Sean trend meter, and even that came down. The bullish percent index ticked down, but is still extreme. And then the 10-day new highs, new lows for the S&P 500. And in the long term, we're still looking kind of extreme here with the 150 and 200. But again, that's just showing that the long-term trend continues to be positive. No change right now with the scenario. Last Thursday, we had economic reports that came out, and they were stronger than expected. And that has the market a little bit concerned that maybe this economic strength could threaten the Fed coming in and continuing to cut rates. And we haven't really seen much of a reaction to that. And it was pretty much confined just to last Thursday. But as the economic reports come out, we'll be watching to see, are these stronger than expected? The dollar was up and interest rates were also up. We climbed all the way to 4.18% from 4.07%. And for some reason, I didn't turn on my laser pointer here. So that's a bit of a concern. That's a pretty big jump with the 10-year yield. We're still inverted with the 10 to the 3-month. We're uninverted with the 10 to the 2. And that happened a few months ago. And we ticked down. We had been at 75 as far as sentiment is concerned. And that's where we get a little bit nervous because now sentiment is getting too positive, and we just ticked down one notch to 74. Now, it was a week ago. We had a really solid Monday, last Monday, and that kicked us up into 75 with the consumer sentiment reading. And then we had the down day on Tuesday. Okay, after Friday, we also were at 75, and then we had the slight down day here on Monday. We'll be seeing if that continues. We are still positive with our trend. The ADX is above its moving average. They're both above 20. That suggests a trending environment. And we are negative with the slight down day, but the momentum still continues to be positive. We just had the leading economic indicators come out, or I know it as the leading economic index. It was down 0.5%, where they expected it to be down 0.3% as it was last time. And here's a chart of that, where it just says the LEI continued to decline in September. Now, the black line, that's what we're following here is the LEI. And overall, it's still continuing to go up, but even though this is a very long-term chart going back to 2000, and it ticked down just a little bit, but the black line is still looking pretty good. That's looking out into the future. If you see the blue line here, this is the coincident economic index. This is more how things are right now. So it's actually going down. But what the market focuses on mostly is the black line. And then here's another look at that where it says the LEI signaled a recession again, because we had come back above this red line here. Well, now we're dropping that back down below it. So you've got a lot of the perma bears and the folks that are just totally convinced that we're going to go into a recession. And I'm not here to say we will or we won't. We just have to look at the evidence as it unfolds. But to declare something dogmatically, like a lot of folks do, they're just feeling, okay, now I'm vindicated right now. We're dropping back down with the leading economic index. Isabel Net blog charts up 10 of 11 months is another clue that the bull is still in charge. And this is part of the reason why we can, at least for right now, maintain more of a positive stance until we have more evidence that things are turning negative. And they're just looking at this chart here by Carson. where when you're up 10 of 11 months, the next month it's up 80% of the time, 3 months up 70% of the time. So it actually drops down a little bit. 6 months, 80% of the time. And then over the next year, the 12 months, we're looking up 90% of the time. So that's real solid percentages or probabilities that the market is still looking rather healthy. We also have the different averages of returns during that time, as well as the median, and they're positive across the board here. And then the current high level of market concentration suggests that the equal weight S&P 500 will outperform. The dark blue line is the equal weight, and it's been coming down, and until about the middle of July, when the Nasdaq 100 hit the all-time high and it hasn't been able to get back there, that's when we saw the S&P 500 equal weight come in and start to do better, which could end up being positive for the market. And that's what we're seeing in a lot of the charts, at least to this point. Even though we're just bouncing back up here a little bit with this dark blue line, if this could continue to go up, that would be quite positive for the market as well. And then the distribution of the annualized 10-year total returns for the S&P from 1930 to 2024. If you talk to somebody, and when I teach classes on this, you say, okay, the average return over the last almost 100 years or so, I usually say 10%. Well, here, according to this, it's 11%. And people go, oh, yeah, 10%. Well, that doesn't always mean you're going to get 10% every year. That's just the average yearly return. Some years it's up 15%, other times it's down 5%. And so, but when you take it all together, the average return here is 11%. And they're going with the baseline here of 3%. They're looking at it this way. But what we've seen over the last decade, going back to 2014, is we're even exceeding that, where the average here has been 13%. And you can see that things are still looking better. You look at this is kind of like a double bell chart here because they're using different time frames to try to make a point here. But it's just showing that this is what the long-term look is. And that's why I have a problem with the perma bears. They're like, yeah, the market's going to fall apart. We're going to see a crash. I mean, if we see a 1% drop, they call that a crash. And everything's going crazy and all these rising wedges and blah, blah, blah. Well, look at this. I mean, this is going back to 1930. That's a pretty good amount of time to look at this. And all these numbers are positive. Yeah, we have difficult times. Kind of the general thing that I've come up with is if you look at a long-term chart of the S&P, it goes up about 70% of the time and down about 30% of the time. That's just the reality of it all. And so we focus more on being positive here 70% of the time, but then there's that 30% of the time where we have to become more defensive, where we can actually take advantage of things and make money when the market goes down. And that's what I teach in my program. Then we expect 13% year over year growth in the S&P in 2025. That's Bank of America. So these yellow areas, even though we're still dealing with the third and fourth quarter here, they're still just estimates as these things are getting finalized, but looking out going forward, they're also seeing positive earnings per share growth. And that, as I always say, just justifies stocks going up. If a company has their earnings going up, then their stock price should go up. And that's the foundation of how stocks really go up and down. Now there's the daily up and down and events that happen, but the base of a company is, are they earning? And are those earnings actually growing? And we see that for the most part going out into the future. Private clients bought munis. These are municipal bonds, like putting up money for a library or a skate park or something like that in a city. And they tend to have more favorable tax treatment. So we're seeing a lot of money going into that. Although dividend stocks, utilities, because that's been a really strong area lately, tips, the Treasury inflation protected securities, which that's what folks tend to get into when inflation is going up and interest rates are going up. Now they have been going up, not necessarily inflation, but interest rates have been. And we're seeing more money going to an investment grade bonds, materials, which tend to benefit more when the economy is well. And then money's coming out of energy right now and emerging market debt, that those are bonds in the emerging markets, low volatility stocks, which as I showed over the weekend, they're continuing to underperform the S&P. And we're seeing money coming out of tech. And that's what we want to keep an eye on because tech is such a huge part of the overall market. It's 32, 33%, I believe, of the S&P 500. So that's why we really keep an eye on the tech sector. And then the market is kind of shifting right now that and if you look at some of the prediction markets and surveys and things, we're seeing a real shift where they're pretty much figuring now that Trump is going to win the election. Of course, that could always change. We still have a few weeks to go until the election actually happens. But one of the things that he's talking about is a cut to 15% from 21%. This would be a 4% benefit to the earnings per share. Now, you may not like that as part of your everyday life, and you're like, well, how come they're giving tax cuts to corporations? But you might really like that as an investor or somebody who's involved in the market. This is seeing an inflow of investment grade bonds right now. These are more conservative bonds, like government bonds, corporate bonds of high quality, and so forth. We're seeing more money going into that. And then we're seeing new privately owned housing units. This was based on last Friday when we had the building permits and housing starts and things coming out. We are seeing a little bit of a bounce up right here from the latest reading. And I did find a couple of charts on Twitter. I've shown this before, and this is why when I have that list earlier in the video of things that we're keeping an eye on, we're watching I have it with banking contagion, which just means it could spread throughout the whole economy, because that's what happened back in 2007 and 2008 and led to the great financial crisis. And this chart has come up from time to time. Everything seems to be okay right now. But according to this chart, there are unrealized losses right now. You can see over here on the right-hand side on investment securities because you have a lot of these banks, especially the smaller banks and regional banks and things like that, that they kind of got caught with interest rates starting to go back up. And so they're carrying a lot of losses on their books. And at some point, is that going to matter? It doesn't seem to have played much of an impact. Well, we had Silicon Valley Bank and Republic Bank, and then about almost a year ago now, New York Community Bank. But we haven't been hearing about this, day after day. Here goes this bank, here goes that bank, blah, blah. And but we just want to be aware of this being in the background. And then hedge funds side with Trump trades. Now, it does suggest that the market is switching over and anticipating that Trump will probably win the presidential election. But don't take this as gospel or anything like that. The day before the 2016 election, there was an 80% chance that Hillary Clinton was going to win. And it didn't turn out that way. So, yeah, these guys can speculate and crowds can ebb and flow back and forth with what they think's going to happen. But it's like Yogi Berra used to say, it ain't over till it's over, kind of a thing. And we don't even know how long it's going to be before we actually get the election results. It's like as technology has advanced, they keep delaying things more and more as far as the election is concerned. And then this is corporate insiders are cashing out. Now, I'm not really seeing that in some of the other charts. That's why I wanted to bring this one up. It says executives and officers, and these are legal insiders. They're dumping shares of their own companies, where we're seeing this really going up right now. All right, let's go back and talk about what happened here, where we did have a little bit of a lower open, but it looked like, okay, we're going to see some immediate buying into weakness, but we came right back up to the unchanged level, and then, pow, we just turned and went down. Now, this went pretty quick. And when something happens like this and it's really not driven by news or anything like that, there's a real wave of selling really hitting. And then it settled down right at about the 58.25 level. And then we bounced sideways. We were able to provide support. And this was the real telling part because we could have set this plateau here and then broken even lower. But that's not what happened. We set up a base right here and we're able to bounce back up, get back above S2. We came up a little bit above S1 and then chopped around above and below it and then ended up closing above S1. So, yeah, we were down, and this can be taken as negative, but the rebound back up could also be taken as positive. Intraday, we're down just a little bit again in the initial overnight session here. And we didn't seem really, we were negative with the futures, and it was looking more negative, but as we got closer to the open, the futures kept getting better and better and better and better. And then we had the open, and then boom, and then down, and then with the recovery coming later in the day. Now, this could be taken as positive as well, because growth actually had a decent day compared to value on the intraday chart, where the blue line now has crossed above the red line. And you can see here the growth to value ratio for the S&P. This looks pretty stinking solid right now. To have a down day and to see this really going up, it really didn't get hit all that hard when the market was going down. So on the end of day, we had growth up where value was down. And you can see there's a pretty wide difference between the two. Mid cap growth was down less, and it was also down less for the small caps. So we saw a little bit of an improvement here, but we're still not looking all that solid with our small cap growth to value ratio. Mid cap growth to value ratio ticked up, but still negative overall. We did come back up with our growth to value ratio for the S&P. So this is holding up for right now, but we want to see more follow through to be more positive. And we saw an improvement here. We had come all the way down and we're getting close to that 250-day moving average. When we look at the growth versus value ETF, we really bounced up, and we're still in the rainbow. But if this could continue to go up and get up out of the rainbow, that would really improve things. And the discretionary to staples ratio, still looking pretty solid here as well. Large cap growth was actually up over 0.5%. So that's looking pretty solid. The condition of the trend, we are still declining with the green line. That's a little bit of a concern, but the ADX is above its moving average and going up. We saw the red line coming up a little bit, but we're still here in a confirmed positive trend. We're seeing that same thing here. We're rolling over a bit with the ADX. So this is what we're going to be watching. If we see more selling from here, is the ADX going to come and actually drop below its moving average? Is the green line going to continue to go down and the red line continue to go up? That's what we'll be observing to see if that happens. And we're still below average with volume. Here's the one sentiment chart that I just show once a week. We're 78.67. We're still in this extreme area. And that's pretty much lining up with what we've been seeing with our sentiment gauge as well. We ticked back up. We're still below 19 here with the VIX, but we're still getting a very high reading. We have the S&P coming off of recent all-time highs. And to see the VIX as high as it is right now, both with the line chart and the bar chart, we're like, okay, what's going on here? You've got a lot of folks that are anticipating a decline that, at least so far to this point, has not developed. And we're also ticking back up a little bit with the VIX of the VIX, both with the bar chart and the line chart. But the momentum of the VIX, you can see how we've been coming down, still getting high readings, but as measured by the MACD, it now has it going down. And we're just kind of all over the place here with the seasonal chart of the VIX. We came down, but we're still above this dashed line when we look at the correlation between the VIX and the S&P. So the market is still kind of nervous about things, and we came down, but we're still in this red area when we look at the skew index. So the market is still anticipating some kind of a big move, and we're seeing a contradiction here. We really went up with this fear gauge, and we really went down with this other fear gauge. So getting some mixed signals. Volatility risk premium did decline, but we're still getting a high reading overall, where there's an anticipation of risk according to this chart. And we ticked up with the equity put call ratio on the daily chart, but we're continuing to go down with the 5-day chart and the 10-day chart. So longer term, that's still looking more positive. The advanced decline line did pull back after setting an all-time high in Friday's session based on price and volume, but still looking solid. We did see a real contraction of the new highs, not really an expansion of the new lows. We're pretty much going flat because we're really near the high end of the scale that's used with the 5-day. That's why I also have the 10-day on here, where it's starting to level out just a little bit. The accumulation distribution, we were a little concerned. We were coming up to the red line with the boom indicator, meaning that maybe we were getting far away from the moving average. And we actually went up a little bit. We saw some of our smart money indicators actually show some improvement. So we're not necessarily extreme, and this is still looking positive here. We did decline, but we're positive with the advanced decline ratio. And now you could look at this a couple of different ways. We're still looking a little more negative here with the chicken money flow since the red line's going down. But based on the sell-off that we saw early and then the bounce that we saw later on, the histogram pretty much finished at the same level of where it finished on Friday, which was an up day, and we set an all-time high. So okay, I don't want to read too much into this. We're still a little bit concerned about this, but the fact that it held up as good as it did is rather encouraging. And the next one, we're actually seeing a little bit of a turn up with the Chaikin oscillator. To have a down day and then to see this going up, we're still positive since we're above zero, but this is still encouraging for the market's sake. And that's why I use these three smart money indicators together to give it more context. And the vortex, we're still going up with the green line, so that continues to be positive. Not really seeing any disconnect here between the S&P and the NYSE advanced decline line. Came down a little bit with the S&P 500 cumulative advanced decline line based on price. Ticked down just a little bit here based on volume. And we came down with the NYSE cumulative advanced decline line, but we're still above the moving average. Ticked down slightly with the NYSE advanced decline line and this other NYSE advanced decline line that's calculated slightly in a different way. Came down with the common stock based on price and volume, but nothing too extravagant, at least yet. We're still looking positive here with the advanced decline line. We did come down with the NYSE common stock, S&P and mid caps and small caps, but all of the indexes are still above this rising moving average. We declined, but we're still positive with those stocks above their 20-period moving average in the S&P. Also positive with the 50-period moving average study. We're no longer extreme. We came back down with those stocks above their 100-day moving average and declined, but still looking pretty solid overall with those stocks above their 200-day moving average. And we've been watching this pivot point here, which is at about the 58, 54 level. I believe that's where it's at. It's really hard to pick this out. A little bit above where we're at right now because the numbers that you see right here are for the current month. We're watching this dashed line. If you look at the high that we set last Friday, that's kind of where we hit resistance at that point. So we'll be watching that on the intraday chart. On the bottom, we continue to be below average with volume. And we did decline, but we're still positive here with the 20, 50, and 200. We had been extreme with the 200 since we were above 80. Well, we've dropped down to 79 now. And we just barely became extreme positive with the Stochk RSI after Friday. Now we're pulling back. And we're coming down, but still extreme with the Williams percent R. The CCI 14 did drop from being extreme positive. We dropped, but we're still extreme with the CCI 20. The condition of the 20-period moving average still going up. Now we fell down below that, but we closed back up where the lines are at. So that is helping both the green line and the blue line to continue to go up. And we're still above the 20-period simple and exponential moving averages. So the short-term trend is still intact. The force index did decline, but we're still green and looking positive there. Coming down, but still extreme in the short term with the stochastic, still going up in the intermediate short term, crossing below the moving average slightly, but still extreme positive with the long short term stochastic. And we're still in the +2 channel with their standard deviations chart. We get concerned if we get up into the +3 channel. That means we've kind of overdone it, but that could also suggest good momentum. However, we're not there yet at this time. Balance of power actually went up. It liked that rebound that it saw after the initial sell-off. And the condition of the 50-period moving average still above the red line and the blue line here. So the intermediate term trend is still intact. The go, no go still remains positive with the dark blue bars. And we came down a little bit, but still above the midpoint and near the highest high value on this chart. But the TTM squeeze continues to just kind of flounder lower and lower with the darker blue. We're still above zero with the ease of movement. We came down after being extreme with the Arun indicator, but it's still looking quite positive overall. This is a little more negative now. We've dropped back below zero with the S&P McClellan oscillator. So that's looking a little more negative. So we're starting to turn down with the summation index based on price and volume. This is an area we want to keep an eye on. We've also dropped negative with the NYSE McClellan oscillator since we dropped below zero. So we're starting to turn back down with the summation index based on price and volume, even though they're kind of hard to see. And this is another bit of a concern with the Swenlin trading oscillator, going down based on price and volume. However, both are still above zero. The momentum, though, is still looking positive. The PMO is going up. We're still looking positive based on price as well as volume. We did decline with the PMOs that are rising. And we're dropping below 50, a little bit of a concern there. The buy signals are turning down a little bit of a concern there, but we're still looking rather extreme with the PMOs that are above zero. That means the stocks inside of the S&P, we have 80% of those stocks in the S&P with a positive PMO reading, a positive momentum. And we've gone from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're still trying to go back up here with the slope oscillator. Now, you could say we're getting extreme because we're going above this green line, and we're still looking positive with the MACD. So the slope is designed to be short term. The MACD is more short to even intermediate term. That's looking good. So in the short term, we're still going up. Intermediate term oscillators still going up. We're going up with the tricks. We're trying to turn back up, but haven't quite crossed the moving average with the KST, which is a longer term oscillator. Trying to turn more positive here with the Copic curve, crossing above its moving average. And we actually declined after being extreme positive here, but we're still looking positive overall with the Sean trend meter. Actually went up with the money flow index and above 50. Turned up with the ultimate oscillator, also above 50. On balance volume, just kind of chopping around, but still above an advancing moving average. The RSI 14, which is more intermediate, that's still above 50. The RSI 9, that's more short term. Both of those are still looking positive. Still above all the plotted moving averages here. Declined a little bit, but still getting a very high reading with the bullish percent index. And still just coming off of a really high reading here with the NYSE bullish percent index. Declined a little bit, but still above 50 with the NASDAQ 100 bullish percent index. And still looking really solid here. And I pointed this out in previous videos, especially over the weekend. If you go back to the beginning of 2024, this is a very healthy looking chart. Yeah, here's the decline that we saw last spring. Here was the big freak out that we saw in the beginning of August, actually a little bit before that. And then that big down day when everybody was freaking out. It was the end of the world and everything. Well, that quickly got beyond that, and we've been able to bounce back up since that time. And we're still looking okay here. This is a little bit of a doji type candle here with the hike and ashy, but overall, we're still looking positive. We're positive here with the Kegi chart, but we are pointing down. It would be more positive if it was pointing up. The Renko chart is still positive with the open blocks, and we're still looking positive with the 3-line break. Long term coming down, but still above this red line with the 150 and 200 period moving averages. Still positive across the board according to the Keller market model. Looking negative with bonds in the short and intermediate term based on price. Commodities are negative in the short and long term. The dollar is in an uptrend now in the short term, but still negative in the intermediate and long term. And we only had one area that was up as far as the sectors, and that was tech. All the other sectors ended up being down, with real estate getting hit the hardest because it doesn't like interest rates going back up. Here are the alerts where Canada started off really good with a new all-time high, setting a 4-year high here. We did see communication getting a BPI cross below 70. That could be a concern because this is a growth area. But later on in the day, we saw the BPI cross for communication go back above 70. So yeah, right when we were selling off, this area got hit, but then it was able to repair that later on. And discretionary is going above 70. That's another area that we want to see do well if we're more positive. The tech sector, it did cross below 70. We don't have any other thing going on there, but we want to watch the tech sector as well. Not really seeing much of a change here when we compare the S&P to the equal weight version of the S&P. The Dow, and we're also watching this pivot level here. Notice this R1 level, we came right up to that resistance, almost up to that resistance, almost up to that resistance. Even in Monday's session, that was a little bit lower than the high. And so we're seeing that lining up on the Dow and the S&P because those are the two indexes that have been setting all-time highs lately. Well, we have mid caps too. The diamonds have gone from being positive to neutral with the Elder's Impulse system. The NASDAQ just kind of chopping along more or less sideways, but it was up over a quarter of a percent. The NASDAQ 100 was up 0.18%, still looking good there. And they continue to be positive when we look at the QQQs with the Elder's Impulse system, where I was leaning a little bit more negative after Friday. It looked like we were dropping below the moving average. Right now, we're right on top of the moving average. And we had an up day with the NASDAQ 100. So we'll see if that can repair things, or if we have some downward move with the NASDAQ 100, this is likely to turn negative as well for the momentum. Small caps, of course, they got to the high end of their range. They had to fall back. That's just the way it goes. And they've gone from being positive to neutral with the Elder's Impulse system for the small caps. We look at the Russell 2000 small caps really declining with the RSI, but still above 50, still above the 50-day moving average, positive but rolling over with the momentum. Mid caps also kind of going sideways here and dropped down 1.19% and have remain, I should say, neutral here with the Elder's Impulse system for the mid caps. The Wilshire, which set an all-time high on Friday, did fall 1/3%. Also falling about 1/4%, was the total U.S. stock ETF after hitting an all-time high. Staples to tech ratio just kind of chopping around right now. Overall, in the short term, this has been declining. That's positive for the market. But we've seen a recent golden cross here with this ratio. That's negative for the market. Financial sector, after setting an all-time high, was down 0.8%. The FANG index was up, but not back to its all-time high yet. Apple was up 0.63%, still looking pretty solid there. Amazon was virtually unchanged, but up slightly. Google was up 0.4%, still above that 50-day moving average. Microsoft, we're waiting to see if we're going to get a death cross here, where you can see the 50-period moving average is at 419.67. The 200-period moving average is at 418. So the shorter term moving average is still above the longer term moving average. Meta was down 1/4%, but still looking pretty solid above its 50-day moving average. Nvidia was up over 4%. That was kind of the stock that I think there was an upgrade by one of the major firms in Wall Street. And of course, everybody loves Nvidia even more. Tesla was down 0.8%, still underneath its 50-day moving average. Netflix continues to really skyrocket up here. They reported earnings on Friday, which really helped the stock up over another percent in Monday's session. And seeing a little bit of an improvement here in the short term when we look at US stocks versus world stocks, but still not all that strong with each other. And the longer term correlation is continuing to decline. Oil dropped under 70 in Friday's session. Now it's climbing back above 70. That's more geopolitical. And the dollar was able to break above its 200-day moving average, even though it's still in a downtrend as measured on this chart. And we really went up, and we're getting above the 200-day moving average here with the 10-year yield. You would maybe think that this might provide overhead resistance. Well, it could always come back down, but if this continues to go up, that could put more pressure on stocks. Now, if this comes down, that may end up giving more support to stocks. And we really declined here with the 10-year based on price. And seeing a little bit of an improvement, but right back up to the moving average with the Qs to S&P growth to value ratio. Discretionary to S&P, after really doing a lot better, it's declining below a declining moving average, where we saw an improvement when we compare large cap growth to large cap value. So the large caps are improving, mid caps ticked up, and even the small caps ticked up with their growth to value ratios. Overall, we have been declining with the S&P to utilities ratio. We want this to go up to be more positive for the S&P. And this is back to declining now when we look at staples to S&P, and that's more positive. To see this going down, usually that means the S&P is going up. So what's our outlook for Tuesday? We are looking positive still. We do have this confirmed Hindenburg-Ullman, even though I'm dropping the chart out of there until something happens to add something, or if we really turn more negative. And we still have these VIX signals that continue to flash. They wore off a little bit, but they're still generating signals for the time being. We're going to get Boeing, Tesla, and UPS coming out with earnings this week, so that could have a real impact. We're not going to have any economic reports on Tuesday, and then the geopolitical things going on, and then the domestic things going on with the presidential election. And it's not just president, there's state elections, there's Congress, there's all these other things that are going to be going on too. But the presidential election is what gets the most attention. So no economic reports on Tuesday. Kind of a light week overall. It might be the jobless claims are kind of big on Thursday. We'll be watching that. Durable goods and consumer sentiment in Friday's session. And here's another look. They only have existing home sales on Wednesday on this particular calendar. Seasonality. This is a little bit of a concern here. October 22nd, we're just really negative. Here, 28.6% of the time we are positive. So that's negative. We're also negative with the S&P. We're negative with the NASDAQ. So we're getting into that week after options expiration here, which tends to be down more than up. This is also what I was talking about as far as potential weak seasonality here. During an election year, the green line continues to go down for the next few trading sessions. And Tuesday is kind of a flip of the coin based on what happened in 2023, but it's slightly positive, but the least positive day so far in 2024. And we're still dealing with a lot of companies that are in blackout because they're reporting their earnings, so they can't come in and buy their own stock. And that could put some pressure on the market as well. So the warning signs, we still have the confirmed Hindenburg-Ullman. We're watching the more defensive sectors like staples, utilities, and healthcare. We're watching energy. I'm watching it more from a geopolitical standpoint here. The S&P and NYC McClellan oscillators and summation indexes, they've now switched over negative. The growth to value, discretionary to staples ratios showed some improvement. Growth had a good day on Monday compared to value. Can it continue? Or is this just a one-day wonder that we saw? We're seeing multiple VIX signals. We're still under 20. We're actually still under 19 right now, but we're still getting quite high readings. And then we're keeping an eye on the momentum for the NASDAQ 100. Positive side, we're looking okay here with accumulation distribution. We're still declining with the Chaikin money flow. But again, I tried to explain that as I went through it. Compared to Friday, it's kind of giving the same reading. And the Chaikin oscillator is actually starting to turn back up a little bit. Advanced decline lines, the equity put call ratio, 5 and 10 period charts, they're going down, which are more positive. Our momentum oscillators are still positive and turning even more positive, not across the board yet with the long-term momentum oscillator. The bullish percent index for the S&P, it's still extreme, but holding up quite well. The NASDAQ 100 and NYSE bullish percent index is still positive overall. The parabolic SAR, the vortex, and the Swenlin trading oscillator, we're a little bit concerned. It's positive, but we're now going down based on price and volume. The money flow, ease of movement, and the ultimate oscillator are also positive, and the financial sector is continuing to look positive. So our conclusion, we're positive, but for right now, we're pulling back. And I took out the Hindenburg thing for right now until something changes there. The VIX signals, that's more shorter term. Those should eventually go away, where that Hindenburg-Ullman could actually stay there for a while. In the short term, we're positive, but for right now, it just looks like we're pulling back. Also, we're positive in the intermediate term. This is where we're seeing if the VIX signals are actually going to come into play. We continue to be positive in the long term. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.